Hey guys, Roshan here, your favorite trader from the Financial Traders Hub. Another week, another webinar for our Discord server members. In this week's presentation, I'll give you the blueprint for success in trading. I'll share with you the crucial differences between trading and investing. I'll also discuss the market infrastructure and what actually causes share price to move both in the short term and in the longer term. We also dissect a profitable trade that we've had earlier in the year, and we discuss the thought process going into the trade and while we've got a live position in the portfolio. Finally, we share with you what's required to become a consistently profitable trader. This not only involves good habits and behaviors of a successful trader, but it also involves the systematic research and trade idea generation process that traders need to keep developing along the way. Grab something to drink and enjoy the video. If you haven't subscribed to the channel yet, I don't know what you're waiting for. Do yourself a favor, subscribe to the channel and give this video a like. Also, for anyone who's genuinely interested in learning about trading financial markets to make absolutely amazing returns, click on the link below in the description to join the Financial Traders Hub for free. It's not going to be free forever, so take this as your opportunity to learn as much as you can from seasoned financial traders. Enjoy the video and do leave me a comment below because I'd really like to understand your thoughts, and most importantly, let me know how I can add even more value to your learning journey as a trader. So before we get started, as usual, this is not financial advice. This is purely for educational basis. I'd encourage you to read the disclaimer. What is investing? So when we look at the financial markets, there are different types of market participants. You've got day traders, you've got short-term traders, then you've got long-term investors. So these are market participants that will be in the market for anything like 6 months and above, sometimes even multiple years. And the vast majority of the fund investment world will tend to have multi-year time horizons for every position. So that's kind of what constitutes the market infrastructure. Of course, it's a lot deeper than this, but let's just simplify things and condense all the market participants into two categories. So one would be long-term investors and the others would be short-term traders. So what do long-term investors do? Long-term investors develop a thesis using certain assumptions that eventually will lead them to a price target. Then they will hold the position for years until their thesis is validated. In other words, until their price target is reached, or until their thesis is invalidated. We'll see a couple of examples later, so don't stress too much about it for now. They then reassess their thesis periodically as more information becomes available. So these would be at certain points like quarterly earnings, investor conferences, industry report releases. They'll be talking to management, analysts who cover that particular industry. So they're always trying to figure out whether their thesis is in line with what reality is saying on the ground, because it's a game where you're trying to predict the future, and these guys are they've picked the hardest game in town, which is predicting what's going to happen, let's say in 3 to 5 years time. It's so difficult because if we go back in time, let's say 3 years ago, we could not even imagine the world we're living now. There are so many variables, so many things have changed, right? So, and that applies to every area, whether it's macroeconomics, whether it's political, whether it's geopolitical, whether it's to do with inflation, whether it's to do with the Fed's policy. There's been such a massive change, and 3, 4, 5 years ago, you could not even have imagined what the world would look like today, right? So that's the game they're trying to play. And of course, they have to have certain milestones set in time where they will always reassess their thesis and make sure that it's still performing. And then in line with these reassessments, they will add to their positions if they believe the thesis is working, or they might reduce their position when they think their thesis is not necessarily playing out or having certain challenges or headwinds. So that's the reason why they will keep reassessing their thesis, just to make sure that they're getting things correctly. And then the advantage that they have is that their long time horizons will allow them to look beyond short-term challenges and sometimes even take advantage of price dislocations. So over a 5-year time horizon, for instance, there are many things that will happen in the stock and in the market that will cause that particular company's share price to move up or down. But long-term investors might look at these short-term challenges as being short-term, in other words, not necessarily impacting their longer-term assumptions on the company. And if their share price drops, they might use this as an advantage to add more to their position. So the core belief there is that their thesis will hold up in time, and that these short-term challenges are basically giving them a better entry into the stock, right? And as I've mentioned, we live in a dynamic world, so there is a constant need to reassess expectations and make portfolio adjustments accordingly. So that's the world of long-term investing. And you have long-term investors who are individuals, so retail investors. You also have institutional long-term investors, and they tend to be the bulk of the market. So the bulk of the transactions in the market will be institutional. So these would be long-term investors like funds, like long-only funds, mutual funds, pension funds, and so on. And these constitute the bulk of the trading volume on a day-to-day basis. And by logic, that would also mean that they are the ones who kind of move the share price. Now let's move on to understand what actually is trading. So this is basically where we play, right? We are short-term traders. We're not necessarily long-term investors, although a lot of what we do comes from the long-term investing fundamental approach. So we still research the market as a long-term investor would, but then we apply our own frameworks as short-term traders to determine whether there's an opportunity to play or not. So short-term trading involves taking short-term positions in anticipation of price movements, and these could be both up and down. Our time horizons would normally range from 4 to 10 weeks. So that's not too short-term, as in it's not a couple of days or even daily or intraday. And it's also not too long. And this is kind of what we call the sweet spot. And that's where we believe there's the biggest opportunity set in the market. Because within this short time period, it's easier for us to narrow down the catalysts affecting the stock price. So as an example, you would have seen many of my theses for now, right? There's always like 4 or 5, it always comes down to 4 or 5 bullet points, right? So we're watching out for 3 to 4 to 5 things happening, which will eventually lead the stock price to move in our direction. Whereas if you go on a longer time horizon, for example, multiple years, there are so many more factors that will influence the stock price. And it's almost impossible, from my perspective, for you to be able to foresee what's going to happen to the stock price path from now till, let's say, the next 5 years. So long-term investors play this game. They take an approach, and they take this approach that they can predict where the stock price will be in, let's say, 3 to 5 years' time. And then their research will often require them to do certain things that we don't necessarily do as short-term traders, which would be things like talking to management, assessing their capabilities, looking at their previous track records. There's also this concept of margin of safety. So long-term investors will need the intrinsic value of the company, which is calculated by themselves. So as an example, if they think the company is worth $100 per share, and the share price is $70, they might deem this to be enough margin of safety for them to start getting involved. So as an example, let's say you come into the office in January, and you've researched a particular company and you think, okay, it's trading at $70 and we believe it should be trading at $100 once it's able to meet all these targets. So all these assumptions. So you will instruct your traders and your banks and whoever's buying these shares for you. You'll instruct them to buy the share, let's say in the range of 70 to 75, right? And it's also important for you to understand that long-term investors will normally have really big positions. So let's say if you want to have $50 million exposure of a company like CarMax as an example, you're not going to put that in one day. It will take you multiple weeks for you to be able to set the position up. And as you're buying the stock, the share price will also be moving up or down, right? So they will normally define a range in between which they will keep buying the stock. And the whole premise here is that they believe that the stock will eventually get to $100 and above, and they'll be able to sell with 20 to 30% profit at that point in time. So different funds will have different what we call hurdle rates. So some of them will say, if it's not 30% and above, I'm not going to put on the position. Others will say we need, let's say, a return on our investment of, let's say, 25% per year. So we need the stock to double or treble in our time horizon to be able to achieve that particular hurdle rate. So every fund is different. Every fund has their own philosophy. Every fund defines their own opportunity set, and they do their research and they will invest accordingly. And one thing that's also important to understand is that these long-term investors, they normally will have in-depth knowledge of business cycles, and they will even have people like analysts or even fund managers who have certain industry expertise. So as an example, they might have an analyst who is an expert in the auto sector, another one which is an expert in banking stocks, finance stocks, and another one who might be an expert in home building, for example. So they will tend to have multi-faceted teams with different types of industry expertise, just to give them an edge when it comes to making these long-term theses. So they definitely need to have in-depth knowledge of the industry as well as business cycles to be able to see out in the future for that long. Now, one thing that I think we don't pay a lot of attention to is if we are short-term traders, why is it that we don't also sometimes act as long-term traders? So I'll tell you why. And there's nothing wrong with being either of them. You can even be both of them. For example, I have two portfolios. One is a short-term trading portfolio, and the other one tends to be a longer-term investor type portfolio. But you always need to understand the dangers of blurring the lines. So you need to understand which hat you're wearing as you're putting different types of ideas in each of these portfolios. So the problem with blurring the lines, especially for beginners and retail traders, is that sometimes what happens is you'll tend to see that when a trade fails, then they'll say, no, it's going to work eventually. So that trade initially started out with a time horizon of, let's say, 4 to 6 weeks. Let's take an example. We put a trade anticipating that earnings will cause the share price to go up, and it doesn't. So now earnings are out, and we're like, no, but just let's give it a couple of more quarters. It will work eventually. So that failed trade turns into an investment. And from my perspective, I always say this: giving a failed trade more time will not solve for a bad thesis. And it's a point that I always try to drill hard on, because there are more chances of this approach failing versus it actually working out. If you're lucky, you'll probably break even. And you will see later the problem of having an approach which is kind of you hoping for the trade to work, as opposed to you taking risk in a very deliberate manner, understanding the catalysts that are going to play out within your time horizon, and then just deciding once your time horizon is over whether you were right or wrong on the thesis. So the problem is a lot of people cannot accept that they were wrong on a particular thesis. So it's a kind of a psychological trait, right? They just cannot accept they were wrong. And that normally comes from people who tend to be high achievers in their lives. So throughout schooling system, university, work, and all of these things that they've been involved in before, they've kind of, from their perspective, won all the battles, right? So they probably have been amongst the toppers in school, university, and at work they're doing really well. So they go into the financial markets with that same expectation that everything they touch will turn to gold, and then the financial markets will give them a proper reckoning. But they just do not take the proper message from whatever's happening to their trades. So that's when they start blurring the lines, and it's kind of a failure to accept that they still need to sharpen their skills, improve their analysis, and work on a lot of things to be able to get better at trading. And one way to cope for them is to basically not acknowledge that it's a failed trade, and letting that failed trade turn into an investment by just letting the time horizon go well beyond what was initially planned. There's also a little bit of retail traders getting emotionally wedded to a trade. So I have a slide later to kind of explain this. A lot of what I've worked with a lot of people so far, right? So I've seen this a lot, and I always ask myself, what does this come down to? Is it the individual, or is it like a human psychological trait that we need to dig deeper into and understand exactly where this type of behavior is coming from? So a lot of times what I tend to see is the reason people behave like this is because they just cannot generate enough trade ideas to be able to replace failed trades in the past. So the trade idea generation process is not as swift, as systematic, and as consistent as it should be. And that tends to be the core reason why people have all these bad behaviors. So as an example, let's say you have a guy who's able to generate one trade in 6 months. Of course, that person will tend to become emotionally wedded to that trade because that trade needs to work for him, right? It's taken him 6 months to get to that particular trade. So you can start to see how not having a well lubricated trade idea generation process starts to impact people's behaviors and performance in the portfolio. On the contrary, if you have a trader who's able to generate ideas consistently week in, week out, so let's say every week he's coming up with 2 ideas and adding that to the watch list, that trader will not necessarily feel that he needs to be emotionally wedded to a particular trade or situation, because if it doesn't work, he'll just cut his losses, move on to a new idea. He fundamentally believes that he can always come up with as many ideas as is needed to be able to replenish his portfolio. So that leads him to have the right behaviors in the market, right? When a particular trade has gone past its time horizon, he will take it off and put a new one in, because he has a watch list that's full of fresh trade ideas that have a great probability of working out. So I think a lot of it comes down to that particular aspect, in that traders do not have a proper trade idea generation process that's yielding ideas for them quite frequently. And It's not kind of a hit and miss system. We'll come to that a bit later. I think a large part of the presentation focuses on that. So what happens as a result of blurring the lines, right? So the portfolio becomes stale. You have ideas that are like 6 months old, and it's also occupying a lot of mind space, right? You're still stuck up with something that happened 6 months ago and still hoping it will work today on, thesis that's 6 months old and is probably not even relevant. So because of that, your mind is kind of stuck in places that, literally it's kind of the train has already gone. It's already left the station. And as a result, when you blur the lines, basically what you'll see is you're not in sync with the current market conditions. You're not focusing your efforts on finding new ideas. You're not focusing your efforts on researching new trends, on figuring out what's driving the market today and in the next few weeks. So basically, by blurring the lines, you're kind of now exhibiting all the bad behaviors that traders should definitely not have in the market. Another thing is, we need to understand that the factors impacting the stock on a longer time horizon could be totally different from those identified in the trader's thesis, which would typically range from 4 to 10 weeks. So as I've mentioned, you're kind of stuck in the past. You're like six months in the past and still hoping that, the idea will work out based on what you had researched 6 months ago, which is now totally irrelevant. So in short, that particular trader is just hoping that the trade will eventually work out. So he's kind of hoping that, eventually the price comes back and he's able to break even or, make a small profit, and then he'll close the trade and move on to something else. But he doesn't realize that there is a big opportunity cost of capital, especially if you're using leverage. So a lot of you who are using leverage, so for example, let's say you've got $100,000 in your account as margin, and then your buying power is, let's say, 400,000. So you've kind of borrowed 300,000 from the broker, and the broker is charging you interest on that 300,000. So if you're not deploying that borrowed capital in ideas that are making you a lot more than the borrowing cost, then you're basically losing money from that perspective. Not just that, there is a big opportunity cost, right? Because that capital that's locked into that trade that has become stale could have been put to use in a trade that generates 30, 50, 100, 200%. And that's literally the cost of you not adopting the right behaviors as a trader and blurring the lines between trading and investing. Also, there's no control on losses. That particular trader will be paralyzed to take a loss because, he just cannot accept he's wrong. He just cannot accept it's time to take a loss and move on to a new idea. For us, seasoned traders, a trade is just one of many, many trades that will happen in our career. We kind of do it and then systematically add more risk, reduce risk, take profits as and when needed. And then once the trade is over, it no longer occupies mind space. Our mind is focused on new things, and it's not kind of having any emotional baggage for us, right? Whereas for these guys who are blurring the lines between trading and investing, they really need that trade to work, and they will be paralyzed to take a loss because they just cannot accept that they were wrong. And what will tend to happen is they buy a stock at $10 expecting it to go to 15. It goes to 9 and they say, no, let's just wait, it will come back. It goes to 8 and no, it will come back. It goes to 6 and they're like, I definitely cannot take a loss now. It's too much. So they keep hoping that the price will come back. It goes to 6.5 and then they say, okay, the price is coming back. So they start to increase their exposure to that bad trade. Then it goes to 7, they add more, and eventually it goes to $3. So they've added more exposure to a bad trade and eventually the share price just moves against them even more, and they make a lot of losses, much higher than what they had anticipated at the start. So there's no control on losses, no control when it comes to risk management, and all these bad practices. So what I've just mentioned is called dollar cost averaging. You're basically increasing your exposure to a bad trade, and when it doesn't work out, which will tend to happen to a bad trade, because there's a reason why a stock is moving in a particular direction. If you're not paying attention and understanding really what's driving the stock and why is it that you're wrong, then these bad practices will cost you a lot of money. I've seen people who basically just ruin a whole account on just one idea because they just could not accept that, uranium is not going to work for the next 3 years. They just could not accept this because they've got, they've read a couple of tweets on uranium, that uranium price will go to the moon, and a couple of prominent people have also talked about it, but they just do not understand that when these people are talking about these fundamental views that they've got in the market, it's probably not actionable today, or it doesn't mean that the price will move in the next 4 to 10 weeks. It's probably true that uranium price will go up, but they're probably talking about the next 5 to 10 years. And you've totally misunderstood that and put something in your portfolio. And you think that just because you've listened to these prominent people, you've followed their advice, and you've kind of tail-coated them that the trade needs to work, and you keep averaging down, and eventually your exposure becomes so large that the price doesn't need to go down too much for you to just blow up. And this is a really bad practice that traders should never engage in. So I hope this is kind of showing you some of these behavioral traits, and hopefully if you had any of these bad practices, you would be recognizing it as I speak now. Sometimes these are actual practices, so actions that you've actually taken in your portfolio, or sometimes these would be some things that you've been thinking about doing. It's like, oh, the share price is down, why do I not increase my exposure to it, because it will eventually come up. So I hope this is kind of giving you an idea of what are the right good practices to have as a trader, and what is totally the wrong type of attitude and practices to have when it comes to trading. So as traders, we focus a lot on what actually moves the share price, right? So a lot of times, in 99% of our discussions, we are focusing on company-specific fundamentals, right? So at the end of the day, we want to understand if a company is growing its earnings power. We want to understand if the company is improving its free cash flow generation power. So, for example, what are the steps that management is taking to improve free cash flow generation or decrease it? So whichever way this is going, it will move the stock one way or the other. We also want to understand if management is changing their policies in terms of how they want to return cash or value to shareholders. This can happen in the form of increasing dividends, issuing a special dividend, or even increasing their buyback programs. So we've seen buyback programs a lot in the last couple of years, especially as companies have been kind of generating outsized profits and outsized levels of cash. So they kind of use this as an opportunity to return cash or value to shareholders, and at the same time also improve their balance sheets and strengthen the company to be able to face upcoming challenges in the future. There's also macroeconomics that also impacts the share price. So we focus a lot of our efforts on leading indicators, for example, the ISM, new orders, the building permits, and so on. So everything that is a leading indicator. We focus a lot on these because these will eventually give us a clue as to what will happen to GDP growth and other measures of other macroeconomic measures like inflation and so on. Liquidity is also another factor that impacts the share price, and that's more on a short-term basis. So depending on what the Fed is doing, whether it's loosening or tightening its monetary policy, that will increase or decrease liquidity in the markets. So as an example, a couple of weeks ago, the Chinese government decided to loosen its monetary policy. And it's also kind of hinted that it will do a bit more loosening in terms of fiscal policy as well. So the Chinese stocks have gone up a lot, irrespective of their fundamentals, because, you know, that increase in liquidity and also perception that liquidity will increase in the future, these tend to drive the stock prices in the short term. You also have technical factors. So these would be, let's say there is a particular fund that hasn't been generating returns for investors. So these investors now decide to redeem their money. So as investors are trying to pull their money from the fund has to sell its holdings to be able to convert the shares into cash to give back to investors. So this kind of forced selling is creating downwards pressure on the shares that the fund will be owning. Sometimes you have technical factors like, let's say, a company has not been doing really well and it's dropped in market capitalization, and a particular investment fund might only be able to invest in a particular in stocks which have a particular threshold in terms of market cap. So let's say a large cap is now becoming a mid cap, and an investment fund does not want to have exposure to mid caps, so it will have to sell that company just because it's moving from one category to another. So whenever we're talking of these technical factors, these tend to be indiscriminate buying or selling, indiscriminate of the fundamentals of the company. You also sometimes have liquidations. So I think I've shared something yesterday to give you an insight in terms of what happens in a liquidation process and how that can lead to contagion across multiple asset classes in different countries. So we've seen situations like global financial crisis. We've seen situations like March 2020 with COVID, where everyone is reducing their risk, and it's just forced selling, liquidations happening across the board. We've also recently seen the technical sell-off that was led to the Japanese yen. So all these events are driving the share price in the short term, and these drivers are not necessarily based on actual company fundamentals. There's also sometimes what we call forced buying or a short squeeze. So as an example, let's say a fund is short a particular company, and then this company has earnings, and it actually highlights to shareholders that it's actually not doing as bad as people were thinking. So the share price will go up as a result of this. And if there was a lot of people who are short the stock, they will have to buy back the stock. And the stock could easily go 20, 50, 100% up in a couple of days just because everyone is being squeezed out of their short position. So these companies are not buying the shares because they think that these funds rather are not buying these shares back because they think that the company will actually start outperforming their peers. They're having to buy these companies back because they're being forced out. Either they're getting margin calls, so their brokers are saying you can no longer short this stock because you already have so much losses on this, and you either need to put up more margin or liquidate your positions. So all these technical factors, there are more, but I've only listed a few. All these technical factors will tend to move the share price in the short term. There's also externalities, right? Like regulations, geopolitics, things like war happening in the Middle East, tariffs, For example, if the US is imposing tariffs on all Chinese imports, so that will tend to move the share price of companies that are exposed to tariffs one way or the other. So some companies might be beneficiary of tariffs if they are local producers in the US, and other companies might be on the receiving end of increasing tariffs. So you could even go out of business if your supply chain was mainly coming from China, and now overnight your input cost will rise by 10, 20, 50%. And not every company will be able to pass that down to their customers. So these external factors, which these companies do not necessarily have much influence on, can also impact their share price in the short term. And also, I think we've spoken about this quite a bit, the risk on and off sentiment. So depending on how investors are thinking about the world, their views on whether GDP is growing in the US or globally, the ebbs and flows, and what's been happening over the year, the prevailing narratives, trends, etc. At any point in time, you will tend to see risk on behavior or risk off behavior. So as an example, whenever I'm doing these price action analysis, this is basically what I'm trying to assess, whether it's been a risk on week or month, or whether it's been pretty much risk off. So as an example, in risk off, with risk off behavior, you'll tend to see cyclicals, financials, and so on go up a lot. Whereas if you have risk off behavior, you'll tend to see these underperforming and defensive stocks like consumer staples, utilities, and so on outperforming the market. So this is kind of where we live as traders. We're always trying to get a sense of everything that's happening at this particular point in time, and then reassessing our views on the market and figuring out what's going to happen next. So I've got this kind of visual illustration just to summarize everything that I've been speaking about. So when we look at the market on a short-term basis, let's say we define it as less than 6 months. So what tends to move share prices there would be things like shifting future expectations of the company or of the industry, sentiment, we've mentioned this just now, liquidity conditions, and also the macro environment. But if you move to a longer term view of the market, let's say over 6 months, what generally will tend to move share prices in those types of time horizons would be more down to valuations. So valuation has a direct link to business fundamentals. So the ability of the business to increase earnings, to improve earnings power, to improve free cash flow generation, this is literally what will move the share price over these much longer term horizons. And with that, of course, the execution of management's operating plan is something that takes a lot of prominence. So investors will be dissecting, what's been happening in the last few months, and whether the expectations are in line with how management is performing. Sometimes what they'll see is management is exceeding expectations. Sometimes it will not be. It will be the opposite, where maybe there are some industry-wide challenges which would be short-term, and investors might be willing to look beyond that. So I think a few times you would have heard me talk about giving benefit of doubt, and this is basically what I mean, right? When investors will look at this particular situation, within this prevailing macroeconomic backdrop, are they likely to give more benefit of doubt to a bad situation or not? And what we've seen at the start of the year was we came into the year where expectations for rate cuts were significantly high in terms of number of cuts, and also where the terminal rates would be at the end of the year. And we only started getting rate cuts like a couple of weeks ago. So as expectations were shifting around rate cuts, this whole point on giving benefit of doubt to certain companies what you could see in the short-term price movements was that a lot of companies that had structural issues, investors were less likely to give them benefit of doubt. CarMax is a particular example. Brunswick Corporation is another one. And there are so many others, you know, particularly linked to consumer durables. Many companies that had problems with their balance sheets, in January and February, they were rallying because investors were like, it's a short-term issue. It will get fixed once rates go down. And then they wait a couple of months and realize that inflation is still an issue. Rates are not coming down anytime soon. So they get more impatient. And on that basis, they will tend to reassess their views and have less benefit of doubt given to certain types of companies. So at the end of the day, when it comes to long-term investors, what they're majorly focused on is value creation from the business operations. So if you think of a company as a box, not as a box, let's say as a water tank, at the start, you probably have, let's say, 20% of the tank filled up with water. The expenses of the company is basically water going out of the tank. And then as the company is running its operations, more water is coming in. So at the end of the day, the value creation is a measure of that water level. So there would be various factors that bring in water into the tank, various factors that take away water from the tank. But at the end of the day, over multiple quarters, what investors are hoping is that the water level would be higher than where they got involved in the company, because that would be an indication that the business operation is creating value and that the share price would also be reflective of that additional value that's being created by management. So I hope this gives you a good understanding of how the market functions and how different market participants are thinking about things slightly differently. So also when you're wearing the hat of a short-term trader, I would highly encourage you to think exactly as a short-term trader would. And when you're wearing the hat of a long-term investor, to think exactly as a long-term investor would. But what we do typically here is more short-term trading. So this is where the bulk of the discussions will tend to be, right? Even as short-term traders, a lot of times we focus on, okay, this situation is happening. We're assessing it from a fundamental perspective, just like a long-term investor would, because we want to understand what would be the conversations in the boardroom or in the investment committees when they actually highlight these issues happening in the industry. Would all these discussions then lead to them concluding that they need to buy or sell this stock? Because at the end of the day, we've started out with the premise that what moves the market is this institutional readjustment of portfolios, right? So we want to kind of get in the brains of the long-term investors, but not necessarily do exactly everything that they do. We're trying to figure out what these conversations would be in the investment committees, and as a result, what would be the actions that will be taken from there. Because you know, the market tends to groupthink a lot. So if an investment fund is deciding to sell a particular stock after a particular earnings report, it's very likely that there's probably 10, 20, 100 funds lining up to sell the stock as well, because they all tend to think very similarly. And as short-term traders, what we're trying to figure out all the time is, what will the share price do next? And to understand that, we need to understand what will the marginal buyer and marginal seller of the stock think after the results have been out. CarMax is a very good example. I speak about CarMax a lot because we've been involved in it quite extensively, and you would know the intricate details in and out, right? So as an example, when CarMax is starting to report higher loan loss provisions, much higher than what it did in the past, what would long-term investors think about that? Would long-term investors like that? Would long-term investors be spooked about it? If I can tell you, if I was a long-term investor and I had, let's say, 50 to 100 million shares or 15 to 100 million dollar exposure to CarMax, I'll be selling every single shares of CarMax, just because I can see that this is the wrong cycle for CarMax. There's a lot of unknowns in the future, and the returns that you'll get from that point in time do not justify the type of unquantifiable risk that you're taking by being long CarMax at this point in time. So post earnings, I think a lot of funds or a lot of market participants, including the analyst, or with the help of the analyst, were kind of thinking it's a benign quarter and that they should just increase exposure to CarMax because it's kind of it's been able to stabilize the gross margins and even increase it to some extent. It was able to beat revenue expectations and so on. And then a couple of days later, when the real guys have assessed the situation, they realized that no, CarMax actually is a play on the loan loss provisions, because Bhavan would remember this. We did an analysis where we showed that the EPS of CarMax was highly sensitive to the loan loss provisions. So if there is a strong link between EPS and loan loss provisions, it makes sense that the share price will also be reflective of what's happening to the loan loss provisions, and also not just what's happening to it now, but what's projected to happen to it in the future. And once the long-term investors realized this, once they had time to discuss it internally and figure out what's happening, you could see that the share price responded accordingly. The share price went up, let's say 6-7% on earnings day, and then the next day it was down. It never went up from there onwards. So it went all the way to, I think, 79.80, and then it just peaked there. It just started coming down from there onwards, and this was literally the long-term investors realizing the situation is not good and them just selling. They're in the market selling every single day. And, that's what's driving the share price down every single day. You can see that in the price action, right? Let's move on. So, from a trader's perspective, right, how do we look at the market? I always say that as traders, we assume that the share price at any point in time is a reflection of the it's a reflection of all the views of the entire market. So across the entire market, there are thousands, if not more, participants, each with their own supposedly independent view, right? The share price will be an average of all these views, because these views eventually lead to a buying or selling decision of the share, right? And these transactions would eventually make the share price move one way or the other. And at that particular point in time, when you pull out a share price chart, the share price path is actually a reflection of what market participants have been doing in the market, right? So it reflects all the investment theses, the range of assumptions, analyst recommendations, and everything that's happened, at that point in time. And as traders, this is the premise that we're using, right? We're saying there's nothing that we know that the market doesn't already know, right? It's a bit delusional for us to think that we know something that the rest of the market that's, day in, day out focused on that particular company or situation doesn't already know. So as traders, what we are basically assessing is what is the state of affairs at that point in time. And then we are working out if there's potential for future expectations to shift the status quo. So what would shift the status quo? This would normally be based on new incoming data. These would be company earnings, macro reports, industry reports, peer analysis, and a lot of other things, right? Depending on the situation that you're looking at. And then once we've kind of firmed up on our views on a particular situation, we will then position in anticipation of the share price moving as these future expectations shift in the market. So that's a slight difference from us assuming that we know something about the market that the market doesn't already know. We're kind of looking at the stock at that point in time and evaluating the status quo and saying, okay, these are the prevailing stories in the market, all the assumptions, all the investment theses are already in the price. What's going to happen next, right? And what's going to happen next, is that going to move the share price up or down? And if we believe that there is a significant move that's going to happen, then we'll position ahead of that, right? It sounds very simple, but it's not that simple when you actually get down to it. But it's also not like very difficult, right? If you know what to focus on, it's not rocket science at the end of the day. It just comes down to knowing exactly what are the right factors to focus on and what's the mechanism of the market, right? So with all that I've been kind of saying so far, I think it's always good to put it to a concrete example. So here I've got a typical investment thesis. It's taken from a fund letter. There's the link below. You can put that in your browser and read it for yourself. And it's for a UK-based company called Vistry. So basically, this company is a home building company in the UK. And this particular fund has a long bias to this company. So it's a company that's kind of transforming its business model to a capital light model compared to the other home building companies. And on that basis, the fund managers are arguing that the company will re-rate in the future and that now is a good time to buy the company. So I don't really know about the company or the situation itself, but I just thought this is a very good illustration for us to use to kind of bring all these points that we've just discussed back in place, right? So you can see that this is kind of a spreadsheet where they are comparing this company to different home building companies in the US and the UK, comparing it on various metrics. So return on equity, EBIT margin, PE, price per book value, and the 5-year growth trajectory of the company, or past historical growth rather. No, sorry, it's the 5-year forward growth of the company. So these are the factors on which they're comparing all these different companies, and they're trying to assess for Vistry whether at this point in time it's currently trading at a reasonable valuation that gives them enough of an upside or even enough of a margin of safety in if they were to buy the stock, right? And then at the bottom of this sheet, they've got different expectations for the growth rates that they've kind of assumed in their valuation model for this company. And then based on these different assumptions, they will come up with what they call an intrinsic value or implied value for the company, which is around $32, while the current share price is, let's say, around $14, right? So, of course, if these assumptions were to play out or to get even better than what they had anticipated, because in their thesis, they will always mention that they are looking at things very conservatively. So they are taking the low end of all these growth rates, and that's still giving them a target price that's giving them an opportunity for significant upside from where the company currently trades at. So if these assumptions are beaten to the upside, then of course there's more upside to the share price. especially if they've taken a very conservative view here, right? So as traders, when we look at the share price, let's say it's around $14, we would kind of work out that at the moment, the expectation of what we call the street or the market is that the company will grow its earnings at, let's say, roughly 14% per year. And these are the couple of assumptions that they've got in their thesis. And as traders, what we will do is we're constantly reassessing whether these assumptions will hold up or not. And we're reassessing this on the basis of incoming information. So as an example, these guys would have come up with this thesis maybe sometime in January, February. And between January and February and now, there's been a lot that's happened. There's been a lot of more information that's come in the market. And we have the opportunity to review these different reports just to understand whether this thesis is doing better than expected or whether the thesis is actually invalidated. And as traders, this is basically where we live. We'll try to assess what's the status quo in that particular stock, and then based on all the information that we've been able to research and assess, we'll evaluate whether these assumptions are actually going to hold up or not. And on that basis, we'll make a buy or sell decision if we think there's meaningful whether upside or downside to the share price, right? So this is basically what I wanted to show you and kind of give you a very visual approach to how traders operate and what exactly we're trying to do at all points in time. Because I really think that this puts everything that we discuss in the Discord server, well, it puts that into perspective, right? So it gives you a very good sense of everything that you're going out and researching. Why is it that we're doing this? And where does it fit into the whole traders research methodology? Because at the end of the day, like I told you, I don't want to imprint my process on each one of you. I want you to be able to think independently, but within the principles of how the market works, right? Because that's what will give you the most chance to succeed in the financial markets, not just now, but over your entire lifetime. So this is an incredibly valuable skill to have, because as institutions, because of the size of the holdings that they've got, they don't necessarily have the same type of flexibility that we do as retail traders to be able to go in and out of stocks. So by us being retail traders, there's a lot of risk, because if we have bad behaviors, bad practices, we can easily lose a lot of money. But if we adhere to the right principles, engage in the right type of behaviors, the right type of analysis, then we also create a lot of opportunities for ourselves where these longer term funds are not able to compete with us. And we really use our size or our lack of an investment mandate as an advantage for us to be able to take these short-term opportunities and make quite significant returns on the basis of these. So this is what I wanted you to really understand. What's the trading blueprint? I'll go a little bit more in depth after this example. So here's another example, for instance. So the same fund, they currently hold a couple of car dealership companies in the UK and in the US. And I've highlighted this in red. So you can see, right, like the US dealers have a return on equity from 14 to 33%, while those in Europe range from 20 to 23, and South Africa is different range. So a lot of times what happens to these long-term traders, long-term investors, is that they will tend to extrapolate things that have happened in the past way too long into the future. So whether that's done out of ignorance, laziness, or just sheer incompetence, I don't really know. I'm not suggesting that this current fund is doing this. The reason I put this up here is because they mentioned that there is a broad range of these return on equities amongst these different companies. Nothing to do against them. I'm just using them as an example here for you to get the framework that long-term investors normally use. So what would tend to happen is, everything in the world is cyclical. The business cycle determines your margin, your rate of growth, and everything else. So what long-term investors sometimes miss is that you cannot extrapolate things that have happened in the past into the future for too long, because the inherent premise is that everything follows the business cycle. And the business cycle will be impacted by varying things like interest rates, macroeconomics, etc. So by definition, it means that you cannot take something like an average over the last 5 years and then use that as your assumption for the next 5 years. This is just not going to work. You will either be too high or too low. So a lot of funds, what happens is they tend to extrapolate these situations, so good things that have happened in the past, and then use that in their thesis to work out a price target on the basis of not so conservative assumptions. So this is where, as traders, we are constantly reassessing these situations, and then we have an opportunity to be more of a bit more of a nimble player, where we're able to reassess these views more quickly than these funds, and then take advantage of dislocations in these theses. So, for example, let's say you assume that the US dealers will have a return on equity of, let's say, 20%. That might not be true for the next 2 years, especially with whatever's happening in the auto sector. So I don't really know what this particular fund has as an assumption in their thesis, but I'm using the range that they've provided as a reference point. And I know about them being long AutoNation for a long time, but I think if I were them, I'd probably start looking at the situation and start taking profits, because the original thesis, and if you marry that with the situation that's happening on the ground now and try to look out into the future, I think that company has probably peaked and it's probably just going to go down from here. And this is what a responsible fund manager needs to be doing. They constantly need to be reassessing these situations and make decisions accordingly. So it's interesting that I think they still are happy to be long AutoNation and some other car dealership companies, which they have picked very carefully. There's not just the business model behind these companies that have been taken into account. There's also a few other things like them having buyback programs and so on that the fund manager has taken into account before, having a long-term position in these companies. But as traders, what we will try to do all the time is reassess these expectations and figure out if, the market might start to move now, because, the expectations and reality are diverging so much that even these guys, the fund managers, will start looking at this and say, okay, I think, we're kind of overstaying now. We need to start selling and take profits on these different companies. And of course, if a fund like this starts taking profit on, let's say, AutoNation, it's going to drive the share price significantly lower, because these guys are going to be selling in the market for the next, 30 trading days. And they're not going to be the only one. They're going to be one amongst the, many funds who are currently selling in the market. And that will drive the share price significantly lower. So just to summarize everything, I think this is kind of an interesting graphic that I've tried to come up with. So as traders, we first of all try to establish what is the status quo, and then we look at the incoming data to figure out what's going to probably change the status quo, and then we position accordingly. I've got an example here where, for example, we have a company where the valuation implies that investors are expecting a revenue growth of around 30% because historically it's been executing well. And it's a kind of a darling for long-term investors. However, when we as traders start looking at the industry and, short-term challenges that are happening, we realize that demand is slowing down industry-wide, and also that, maybe the input costs of that company is rising. Could be raw material prices rising, freight rates rising. So these are things that could not have been priced in, at the start of the thesis of long-term investors. And we also assess the sentiment around this particular stock or its industry. And let's say we realize that for the next month, it's going to be more of a risk-off sentiment, which could cause a significant rotation of assets to the value or defensive stocks. So that presents a very good opportunity for us to have what we would call a short thesis being developed and implemented. And in a situation like this, the company could easily drop 30-40% in the next 6 to 10 weeks. So as short-term traders, we want to participate in these types of opportunities. And this is the bulk of what we do, right? We're always trying to reassess all these assumptions, and on the basis of that, figure out whether there's an opportunity to get involved or not. Maybe now move a little bit further. So when it comes to our thought process as traders, so we're always trying to figure out three things. What's been driving the stock in the last 6 to 12 months? What's been the story for this stock and its industry? So a large part of our research will focus on that. And you would have seen that a lot of my theses follow this format, right? I'm always trying to ask you, so what does the company do? What's driving the stock? What has been driving the stock? What's the story in the industry? And then the next thing that we'll focus a lot on is what's changing now and what could affect the future expectations related to this company and its industry. And then on the basis of that, we'll move to the next step where we'll ask ourselves, is the market starting to recognize this change? Or is it already priced in, for example? Because if we put a trade on something that's already priced in other words, not actionable, then it's likely that over the time horizon, the share price is not going to move in our favor, or it's going to go sideways, because all of what we've got in the thesis has already been priced in. So that's why we always need to find actionable catalysts that are going to happen in the near-term future, and not, look at things that have happened in the past and try to extrapolate too far ahead. So this is an example that I had shared in the Discord server. It's under the post-mortem thread. So this is the company called BRUNSWICK Corporation. They manufacture boats and related parts like engines and so on. So if you read the comments, as an example, when I was looking at this trade, we were somewhere in March. So you would see I don't know if you can see can you see my cursor?
Yes,
okay,
we can.
Right. So I'm getting involved at this point in time, right? We're currently somewhere here. So my line of questioning is what has been driving the stock in the last 6 to 12 months, right? All of this, what does it come down to? I really want to know, right? What's been driving the stock here? So I'm going to go a couple of quarters back and see what's been happening around earnings and how has the share reacted accordingly. So I'll probably go back 3 quarters, And then I realized that this is where the company starts missing earnings. So they miss in this quarter, and then there are early concerns about demand falling. The stock sells off, but it's not necessarily that, not necessarily that brutal, right? It's just like a slow drip every single week. So basically what's happening here is your long-term investors are kind of readjusting their portfolios now, right? And this is happening over, let's say, 6, 7, 8 weeks. And it keeps on going into the next earnings. So basically, at earnings, you've got reassessment of the investment thesis. They're making adjustments to the portfolio. Then from here onwards, this is basically people who are looking out for the next quarter, for the next quarter's earnings. So because they missed in the last quarter, and also the management had highlighted concerns about demand falling, you've got a lot of market participants who start positioning themselves as short in the stock, whether it's short or whether it's long-term investors taking profit or just getting rid of the stock now. So the share price keeps going down into earnings. And then at this point in time, for this earnings quarter, they actually beat expectations, and then management makes some upbeat comments despite the demand slowdown. So of course that gets all the shorts squeezed, because the share price starts going up. All these guys who have been short from here, they start covering their shorts, and that pushes the share price much higher, right? At the same time, we also have a little bit of macroeconomic development happening, whereby in early November, the Fed's, and we're talking early November 2023. So the Fed comes out and they start hinting that we've probably peaked in terms of interest rate hikes, that they will start looking at inflation and reassessing whether they need to start cutting rates now. So, of course, for a company that relies on debt, that relies on accessibility of cheap finance of their customers, that's very positive. So the stock rallies, and at the same time you have a short squeeze. But what I'm trying to say is a lot of this move is not happening because of improving fundamentals within the company. These are technical factors plus macroeconomic developments that are just causing the stock to rally. And it's quite a significant move, right? It goes from, let's say, 66 all the way to, let's say, 100. That's almost doubling of the stock. And, that particular move is not even based on actual fundamentals. So, of course, what happens next is the stock is not able to make new highs. So a lot of people who are long here, they start selling, and you've got more shorts who get involved in the situation. Eventually, at the next earnings, what happens is the earnings miss again, but management is still upbeat. So because you've got a macroeconomic environment which is loosening in terms of there's likely the Fed is telegraphing that you might have rate cuts. So the market starts giving a lot of benefit of doubt to companies like BC, CarMax, and so on, where they rely on cheap finance for their customers to be able to buy their products. So the market kind of dismisses the earnings miss, and the stock rallies from here, right? So here also you have a bit of, let's say, people who came in short at earnings getting squeezed out of their positions, or them just realizing that the stock is not going to go down further. And it also kind of found some support at this 200-day moving average line, right? So that leads to a rally in the stock. And then now I'm kind of standing at this point in time. We're kind of, let's say, mid-March. And I'm looking out to the next earnings quarter, and I'm figuring out to myself, so what could happen next to this company? So I've already answered these questions. What's been driving the stock in the last 6 to 12 months? What's been the story for the stock and its industry? Now I'm trying to assess what's going to happen to this second point. So what's changing now and what could affect future expectations? So of course, I review my thesis on the company, and it was not the first time I was playing this company. I had played it multiple times in the past. So I knew a lot about this company. I'm just revising my thesis, refreshing it with more new data. And then I realized that, the business is actually not doing that well, not just for the company, but also across the industry. When I started looking down the value chain, I realized that there's a lot of inventory at the dealerships. So there's a lot of boats already that the dealerships have, and they're not going to order new boats from the boat manufacturer, which is BC in this example. So a lot of these dealerships, what they will do is they will take out loans, and that's called, I think it's called floor plan. So these loans will then finance the inventory that they bring into their dealerships. And of course, if the Fed is telegraphing that rates will go down, so there's a little bit of positive sentiment in the industry that this will kind of stimulate demand for more boats by the dealerships from the manufacturers. But they don't realize that the dealerships are already flooded with inventory. And they're not going to order new boats. So around this time, I think in the last earnings, what happened is management was also starting to, the language was changing a little bit, and they were indicating that they are going to start doing more discounting in terms of their prices to be able to move inventory. So that's a big signal, because it's telling you that the demand is coming down for that particular product, and they are having to decrease their prices to incentivize, dealerships to buy more. Because as a manufacturer, your fate is kind of tied to, how many new orders you're getting from your dealerships. So if the end customer is not ordering a lot of boats, dealerships are not able to move a lot of inventories. Dealerships will not order a lot of new boats from the manufacturer. And you can see how the contagion just flows through the value chain, right? Irrespective of what the Fed is saying. But we have to be cognizant that whatever the Fed is saying is also impacting the share price. So that sentiment is moving the share price. So when we look at the whole situation, we always take a very fundamental analysis approach in every situation, while at the same time marrying that with what's happening with macro sentiment, technical analysis, and so on. But at the core of our analysis, we're doing a fundamental business review, right? Trying to understand what's happening at this point in time for the company and what's going to happen next. And we realized that all these business fundamentals are getting worse for the company and its industry and its value chain. And this is the point where I start building a short. I think I started building my short after the share price peaked here. So you see this red candle here. I realized that the stock is not able to make a new high. So there was a failure here in terms of making a new high. And then this was another failure, which was lower than the previous high. And this was kind of my signal that going into earnings, I actually want to be short. So I started shorting it around, I think it was around 93 when I started shorting it. And it went all the way down to, like low 70s, if I'm not mistaken. I think I took profits around 80 or 78 or something. And it was like a proper home run trade, right? Going from 93 to 78 with options, that's a massive return. And one of our members, I don't think he's present today, he made a lot of money on this particular trade. He did not play it with options. He had like a proper, like a vanilla short shares position through CFDs, if I'm not mistaken. And he made significant money, just understanding the mechanics of how the market works, and when there's price dislocation in one particular direction, and what will happen at earnings when the management is kind of almost condemned to not condemned but compelled to actually tell the truth to the market, right? They have to tell investors that it's a difficult environment and they're not able to move boats, and once the share price goes below the 200-day moving average, you can see the share price just keeps going, because investors now realize that the initial thesis, probably from a couple of months or years ago, is not actually going to work out in what's going to happen in the next 12 to 24 months within that industry. So I think this is a very good example to put everything that we've discussed over the last few slides into something that's actionable, something that I've actually done in the market, and it's yielded great results. So I'm not telling you that this is always what you need to do whenever you're looking out for trades, but this is kind of the principle. This is the thought process. Take it, do whatever you want with it, make your own process. You can find something that's even better than this. Maybe you realize, okay, this guy is just so simple, so rudimentary, I'm going to add more things to my thesis. I don't really care, as long as you're right at the end of the day. That doesn't really matter to me. But what I'm trying to say is this is the proven thought process. This is the proven blueprint that I've used for many years in the financial markets to make significant returns with these types of situations. And I'm not an expert in the boating industry. I don't think I've ever, in the last couple of years, I've probably been on a boat once. It's not like I'm fond of boats or anything like that. I know nothing about the boating industry. And yet, I'm able to come in, evaluate the status quo, and figure out whether there's room for significant changes into the future, and whether the share price could move on the basis of that. So, this is kind of what I'm trying to impart with all these webinars, and I really think that this is a very good illustration of how to think about things. And as a trader, this is literally where you're living every single day. You're looking at things and trying to evaluate whether investors will be up for a reckoning or not. So moving on, what does a trader's mandate look like? So a trader is never looking to pick the top or bottom in a stock or in the broader market. We're not dogmatic. We're not the guys who say S&P will fall by 40% in the next 6 weeks, or gold will go to $30,000, or Bitcoin will go to the moon. That's not us, right? We stay very close to the action. We are very realistic. We always look our thesis and ask ourselves, is this realistic? Can this actually happen? Does the stock or the instrument we are trading has that type of volatility profile, right? For example, let's say if I pick up a stock and I'm like, okay, you should buy calls in that because it's going to go up 500% in the next 6 weeks. You definitely would look at me and say, but the stock doesn't necessarily have that type of characteristic. It doesn't have that volatility profile. What will actually cause the stock to go high by this much? And if I cannot put my fingers on the actual actionable catalysts that will justify that the stock will go up by 5 times, then you should not believe me, right? It's as simple as that. And as traders, we always want to have risk return in our favor. So we're always looking for asymmetric risk return profiles. We want to risk $1 to make at least $3, right? And that's irrespective of whether we're trading stocks or options. So a lot of what I discuss in the Discord is around options trading, but this philosophy also applies to stock trading. So as an example, if you buy a stock at 100, let's say you've told yourself, I'm going to risk $1,000 on this stock. And so if my stop loss is at $1,000, what should my price target be? It should be at least $3,000, right? I'm talking of the share price that will get you to $3,000 of profits. And if you cannot justify that this profit target looks reasonable within your trading horizon, you should not be taking the risk. So you're always risking one to get at least three. And with options, it's a lot more obvious that we're doing this because there's an actual outlay of capital that we put in our portfolio to take a particular risk. And we also work out the payoff in different scenarios for different price targets. And we can figure it out for ourselves if there is a potential for, a 1 to 3 risk return profile. With shares, we can also do the same. The philosophy is still the same, whichever way you're trading the markets. So, as I've mentioned also, we also have an average trade horizon of 4 to 6 weeks. And you're always aiming to expose yourself to situations which can move by at least 15%. And that's irrespective of whether you're trading shares or options. We have to keep in mind that this can get more difficult in sideways markets and in low volatility environments. So when VIX goes below 15, the volatility of stocks goes down significantly. And unless there are actionable catalysts, it gets a bit more difficult to find situations where, stocks can move by more than 15% or at least 15%. As traders, we also always need portfolio diversification. We've talked about this a lot of times. We always need to have longs and shorts, irrespective of the type of market we are in, whether it's a bull or bear market. We need to have different types of trades. So trades that are linked to earning acceleration, decelerations, turnaround stories, corporate actions, pain trades, tail risk trades, etc. I'm not going to go too much into detail about these now. I think this is something that we'll need to discuss in subsequent webinars. We also need to diversify by factors: market caps, cyclical value, growth stocks, sectors, industries. So this is what we're always talking about when it comes to portfolio diversification. I think this is something I spoke towards the beginning of the webinar. So the typical pitfalls for retail traders, right? They cannot find good trade ideas consistently. So they'll find like one good idea in 6 months. So they're not equipped to find long and short trade ideas as regularly as, an active portfolio would require them. They're not skilled to analyze multiple industries and generate trade ideas within. There is this saying from Warren Buffett, right? That you should not go outside of your circle of competence. I totally disagree with that. I think you should always try to expand your circle of competence. In the corporate world, I think quite a few of you might have heard this or even used this. It's kind of to me, this is a cardinal sin. Whenever you say, this is above my paycheck or payroll, or what's the typical this is above my pay grade, right? This is above my pay grade. If you ever say this to yourself, just just slap yourself, because this is a cardinal sin. You should always rise to meet your standards and not set your standards so low that you're just functioning at a very low level and you're happy with that situation. So, if you have one circle of expertise or competence, let's say you've worked in insurance for 10 years, sure, there's a benefit in focusing on that, but if nothing happens in the financial space for the next 2 years, are you just going to be like doing nothing in the market? You need to expand your zone of competence. It's critical. I wasn't an expert in all these industries like 10 years ago when I started out. I had to learn every single thing, and the information is out there in the public for free for you to be able to get all the pieces together and string them together and form your own view on industries and sectors, companies. There is this exercise that I will do for the industry research for restaurants. I think that will give you a very good systematic process to follow, and that's transferable to other industries as well. But yeah, not to belabor the point, moving on, I think what retail traders also struggle with is not having a systematic research process and trade idea generation process. And that's the cause of all the bad things that you see happening to retail traders. They'll occasionally find one trade, bet the house on it because they know they cannot find, like a trade every week. So if they read something about uranium going to the moon, uranium it is. They wake up the next day and they are like a uranium bull. Everything they talk about is just uranium. So there's no portfolio diversification. They've just bet the whole house on something that they haven't even independently researched. So this is more gambling as opposed to taking an educated risk in a particular situation that you've researched yourself. So you borrow an idea from someone who wrote a Twitter post, a blog, or was speaking on CNBC or whatever, but you cannot borrow that person's conviction, right? So if the trade is not working, what do you do? Do you get out of it or do you buy more? You will not know what to do next, right? Because you haven't done the work, so you have zero idea as to why it's going one way or the other. Retail traders will also tend to overstay. So a lot of times they'll be in situations, make unrealized gains and then give it all back to the market because they just don't know when to take profits. And that comes from not having conviction and not having discipline, not having a firm trading horizon and not operating systematically within those rules. You also tend to find that retail traders are always lagging behind. 90% of the energy is scrolling financial media, sending shit to their shit friends. Did you see this? Did you see this YouTube video? Did you see this Bloomberg video? Did you read this article? I think this is going to happen. It's always like borrowing other people's research views, and that's just the lazy way out, right? The ones who think they are a little bit more sophisticated will go and look for SEC filings, mainly the 13F filings, and try to find out what other fund managers are buying or selling, and then they'll try to tail code them. But they don't realize that everything that's reported is a quarter late, and if a fund manager is buying or selling something, it doesn't mean he or she is bullish or not bullish on the company. There are various reasons to be buying or selling something. What you see on Twitter a lot of times is like these high options trading volume alerts, right? Someone just bought this many puts on the S&P or on a particular company. Does it mean that the person has a bearish view on the company? Not really. I mean, there's many reasons why you could buy puts or calls. It could be to hedge yourself. It could be because you have a bearish view. Many reasons, right? Just one transaction is not reflective of your underlying view on the company or the market. And anyway, no one should be looking at another person and then, just mimicking them like a monkey. So basically what retail traders do is just hope, and hope. And that's not a situation that's sustainable. Eventually, the market will find them out, and it all ends up in the same way. So just quickly, why is trade idea generation so important? I think I can even skip this slide. It's been expressed throughout my presentation, quite strongly. So the reason trade idea generation is important is because you need a watch list full of fresh, actionable trade ideas that will work in different market environments. As traders, we recognize that every week, month, market environments can change quite significantly. And we need to have actionable trade ideas all the time for these different types of environments. So the ideas in our portfolio also have a finite time horizon, and they need to be replaced by new ones, right? If we're trading on a 4 to 10 weeks time horizon, when it comes to the end of the time horizon, we'll need to take off the trade and put new ones. If the watch list is not full of fresh, actionable ideas, what are you going to put in your portfolio? It will just be, like either you have too much cash in your portfolio, which you're not putting to good use, or you're overstaying in stale trades because you just don't have new ideas, right? And finally, the market environment can change significantly, which means that your portfolio needs to be adjusted for you to be in sync. So your bias in terms of being net long or net short will need to be readjusted based on what's actually happening in the market. Your allocation to cyclical, defensive, growth ideas, whether it's long or short, that will also need to be adjusted from time to time. And you'll also need to put or remove trades linked to certain themes like market cap related themes, interest rate sensitive stocks, USD weakness, recession, and all of these themes that we normally talk about. I think this is my final slide. So I think this is quite an interesting one, right? Like the retail trader is always on a hamster wheel, while the good seasoned traders, they always have a flywheel of ideas. And I think you would have seen the way we operate in the Discord server, right? We're never scarce when it comes to ideas. We're never betting the house on a particular situation. We're never saying we really, really, really need this situation to work out. And the whole reason behind it is because we live in a world of abundance. Abundance linked to the amount of opportunities that we believe that we can create for ourselves. We know that the market will always move. And if we have the right skill sets, we'll always be able to find a minority of opportunities from all these market movements. And from these, be able to have a portfolio that's always fresh with actionable ideas. So a trader's core skill set is centered around trade idea generation. Traders need to be constantly in sync with the market. We need to understand the prevailing trends, narratives. We need to stay on top of incoming new data. As an example, we're heading into earnings season. So this is going to be quite busy for us because we'll need to look at certain earnings reports and reassess our views on industries, the markets, companies. We need to keep developing domain expertise in more industries. So research, and more research. I think it links to my point before. We need to keep expanding our circle of competence. We need to be able to gauge positioning in the market. I think the example on BC that I showed you with the stock price chart is going to give you a very good idea of how I look at charts to understand the prevailing trends, narratives, and also gauge positioning of investors and traders in the market. And then we need to assess areas with shifting expectations. Sometimes we'll have to be a contrarian, or we can just say, let's put that in the watch list and wait until the market starts recognizing the catalyst that we are seeing. And then we start putting the trade on. So it really depends on what you've got in your portfolio, how you want to play a particular situation. And everything comes down to the conviction that you've got on a particular trade. And finally, we have risk management. So risk management takes two forms. One is before you put the trade on, you have to research it properly, make sure you haven't missed anything. Use myself as a sounding board. I think we've done quite a few of these trade reviews, and you would have learned quite a bit from you know, the way I look at the situations and the questions I'm asking, then you have to structure these ideas properly so you get the asymmetry that I mentioned earlier. And then once you've got the position on, you have to manage the live positions in your portfolio. That's another form of risk management. So that's basically what a proper trader who's consistently profitable needs to be doing in the market. These are the very good behaviors of traders. And you'll tend to see that institutional grade traders will tend to follow this type of behaviors, whereas retail traders are just, you know, very haphazard in the way they look at the market, in the way they put risk in their portfolio, in the way they manage risk, and, you know, everything is just haphazard because it's not being done systematically with the right principles in mind. And quite literally what's happening is they haven't been taught to do it the right way. Okay, so I'll end off here.